Thanks for joining me here tonight. As we spoke about, we'll be discussing why Houston is a prime market for real estate investors. And just like to introduce myself, I'm Blake. If you may be able to tell, from Australia, and I'm a mechanical engineer with 8 years of project management experience. I've done probably about $150 million worth of CapEx projects across my time in industrial, commercial, and even mining infrastructure projects. And I suppose it just got to the stage where I thought to myself, why am I thinking of continuing to run projects for big companies? And why aren't I doing it for my own company? And I suppose that's where I started leaning into creating Kingshurst Capital and focusing on US real estate. And for many years, I was doing single family real estate in Australia, just saving up money, buying a property, saving up money, buying a property. And yeah, I sort of was looking at it and thought, geez, I think in 10 years' time, maybe I'll be able to not have to work anymore. So surely there's a better option out there, which led me to US real estate. And about 2 years ago, I started researching about it, learning about it. And in February of this year, 2024, decided to leave my job and pursue US real estate, in particular multifamily. So the Houston market, there's a lot to really enjoy about the Houston market and Texas as a whole. As you can see here, GDP of $525 billion, the fourth largest economy in the US. Houston also is the fourth largest city in the US, population-wise. And if you look at the growth of Houston, it's had a 20% population growth over the last few years. It's just above 7 million in the metro at the moment. And continually there's construction contracts being brought out just through to the ease of being able to do that in Houston, the zoning and a lot of other different things that just make it very viable to be accepted and done. And great real estate at the moment, the trend is 95% occupancy in property that's currently established and stabilized. So anything less than that, obviously that's the sort of B's and C's properties that are unstabilized that we sort of look to obtain and get them up to that 95% of occupancy rates to be able to get that higher revenue and better pricing. But the demand for the rental housing has increased 3.5% year over year. And when we look at that, figure there, the 3.5% of the demand, you can see that comes from this sort of page here, population growth and economic drivers. If you can look at the Fortune 500 companies, it has increased over the last few years. This is just in Houston, right? That there's 25 Fortune 500 companies. That's the third most in any city within the US. The first is in New York. I believe they have like 61 Fortune 500 companies. And then the second is Chicago. I think they've got like 29. So just a couple more than Houston. And when you look at the big companies, like the big companies, especially in energy is a big one, aerospace, healthcare, as noted there. But you look at like Chevron, ExxonMobil, they've got their headquarters in Houston and a bunch of others, ConocoPhillips, and they're massive across the world in the energy. And when that goes and there's a push for energy, and because I was in the mining industry and I've seen what can happen when they're really driving. You see people driving with two cars, not at the same time, but they've got two cars, they've got two boats, they've got 3 motorbikes, and you're sort of wondering, where's all this money coming from? And that's just the impact that energy and mining can have when it's really going guns blazing. So it'd be interesting to see when that starts to pick up just that little bit more again. And obviously, money brings people in. Now, not all people are working in the energy, but a lot of people are still there for aerospace, healthcare, which are high-paying jobs, right? So you've got 120,000 new residents essentially year on year. And a lot of these people are coming from places like California and other places where maybe they're getting paid good money, but Houston just has that good amount of a salary, and it's got that good gap between the cost of living. So we can look at that later down the line, how that comes into play with the rental market. But yeah, big companies being able to provide great opportunity, great salaries that will move people from across the country. I was thinking across the globe, even sometimes, with some of the opportunities that can be presented with some of these big companies. So yeah, it's definitely a draw card for a lot of people. So if we look at the strategic investment opportunity, yeah, in Houston, it's great because it has that it's got that higher cap rate. And with that higher cap rate, it means that it's able to draw a lot better returns than what we can see Dallas and Austin and essentially those larger markets, especially like New York or Los Angeles or something along those lines. Because with that lower cap rate in those sort of cities, the lower cap rate means that you're going to be paying more for the property, which means that your mortgage is going to be a lot more, which increases the amounts that you have to pay month in and month out, right? Which just takes away from your cash flow that you can earn in your NOI. So Class A properties, especially in the suburbs, they're the ones that have that lower cap rate, and that just comes down to that better, higher quality. It's lower risk. You see a lot of people they were shifting towards that at the later part of COVID, just that more lower risk and that higher quality product. But that could just be down to location, a bunch of different things, location, the age of the property, a bunch of different things are at play in an A-class property. So as we stated, rising demand of housing. So that's the rent has still risen by 3.5% year on year, the rental demand. So people are still wanting to rent. And that definitely can come down to the higher interest rates that have been for the last few years, just keeping people out of owning a property, and essentially strong rental growth. So I put here that it's 4% generally annual rises in the rental growth. And I say general because, over the last year or so, it hasn't been that 4%, but typically you can see about that 4% rise, that steady rise year on year. And that outweighs a lot of the other US cities. So in comparison to the national average, the cap rates in Houston are that little bit higher. As I spoke about, it's able to provide that extra bit of cash flow. And investors looking for the value add opportunities, the Bs and the Cs, which is where we focus at as well, like Bs and Cs. We're not really in the A-class property game. You can find that higher cap rate, and depending on the location, what you're sort of going to get, but around that 6.25% at the given time. So I keep flicking myself on different sides here, but Houston leads with 25,000 units, outpacing Dallas and Austin, which you can see on the graph there, just over the years, the trajectory that it is with the increasing, construction over the years from 2018 all the way to 23. It's just that nice linear line upwards in that upward direction. And if you look at anything in terms of Houston, you look at job growth, you look at rent growth, you look at every sort of growth indicator that you can look at. It all has this great trend to it, much like the graph that's on the page at the moment. So all positive signs, right? And I suppose if we can look at the 25,000 units that are coming online, and we look back at the 120,000 people that came to Houston, not Dallas. We look at that, and if we look at the average family of Houston, it's 3.5 people per family. So that doesn't mean that we cut somebody in half or anything like that. It just means that some families have 3, some have 4, and in the middle is 3.5. So the average is 3.5. If we can look at that, so the 120,000 people, we'll pretend they're all families. I'm sure there's some single people out there, with no kids, and they're taking a whole unit to themselves, but we'll ignore that. We'll ignore that stat, and we'll just go 4 people per family. So if we divide that, so it equals from that 120,000 divided by 4, so that's 30,000 units or properties that we need to service that 120,000 people. So if you look at the 25,000 compared to that 30,000, the supply doesn't meet the demand at this point. So you can see in the next line there, that positive rent growth, that 1.5% that's happened, even due to the economic challenges, the inflation. It's been kind of a a flat market over the last 12 months or so. It's been very stagnant, but Houston's still able to raise its rents, and it just comes from essentially still that strong job growth and the population growth, right? And it comes from the young professionals, families, energy and healthcare. They're all getting paid good money. They're coming from outside of the state, and essentially they work hand in hand to be able to deliver that better rent. So again, Houston offers that 95% occupancy rate, and that just keeps driving hand in hand with everything else that we're spoken about. And stable growth policies, low cost of living. So essentially, Houston has those very flexible zoning laws, right? So that helps a lot of companies, a lot of big time developers as well on being able to bring units or bring industrial different sort of things to the market within Houston with sort of less hoops to jump through. And with that low cost of living, it's bringing people from all different states, right? But in particularly, the one that sort of shocks me the most, not really because of how things are going in California, but in terms of people actually leaving a beach, to leave the beach, to leave the ocean, normally it's the other way around. People normally give up their life and move to the beach because it's that better lifestyle, right? And whereas you have Texas, you have Houston. Hey, there's a few beaches in Texas and around Houston, but come on, they're nothing special. Come on. And people are leaving those great beaches in California, moving to Houston. Why is that, right? Why are they leaving that lifestyle, that great right next to the beach for inland? It's so rare. People are normally going the other way. And it comes down to that cost of living while still being able to make that great wage. Maybe the salary they were making in California was the same, or maybe that little bit less than the opportunity that they're able to get in Houston. So they're getting still that higher wage. The cost of living is lower, and their expendable cash is just that higher bits. They can either do the things that they want to do, or a lot of them can spend that extra money on even paying that little bit more rent, because the rent's going to be cheaper in Houston than somewhere in LA where they're moving from. So they don't mind bumping up that rent that little bit more. You see it everywhere in every sort of market that has this sort of, they're coming from an expensive market to a more, cost friendly market, and they sort of bump all the prices up. So infrastructure and development, as always, Houston has heaps going on. I think I was reading the other day that the council, the local government was putting on, I think it was about 14 billion in wastewater and water system upgrades across Houston. So they're obviously not, sitting on their hands and waiting for things to happen or go bad. They're being proactive about it, and they're wanting Houston to be one of the best cities in the country, right? Along with that, Port of Houston has a 1.7 billion investment. It's mainly just a lot of the infrastructure on the land side, I suppose. We all seen the issues. I suppose it's a different case, but during COVID, we had a lot of shipment issues. We had a lot of those delays. Obviously, that's a different case in many senses, but they've obviously identified a way to be able to get the products into Houston and through the process a lot faster, so it can be distributed not only to Houston, but the wider community into other cities as well within the US. So that's being upgraded. The Houston spaceport's there, 4 billion investment. Essentially, that's 4 billion in contracts that'll be happening and that are underway as well. Phase 2 commencing in the next 12 months. That's pretty much just the roads, aircraft taxi, retail development around the area. That's pretty much, that spaceport. It's working alongside NASA. There's like 3 companies that have come together with that. And essentially NASA's the systems that they need up in space, can be their space suits, can be their waste systems, just all these different type of things that get created and tested will be in that Houston spaceport. So it's pretty interesting. And obviously along with that, we spoke about the 25,000 multifamily units in development, billions of dollars invested into the commercial projects there. So what is driving Houston's rental growth? Like we spoke about, right? You've got those job opportunities, 70,000 new jobs, which is low. That's low for Houston. Normally it's, it's closer to the 100,000 mark. It's that little bit more. It's actually Yeah, it's actually higher than that normally. And then along with those jobs, you've obviously got people coming from everywhere, migration from different states. Like we spoke about, people coming from California, leaving the beach for these better opportunities. So that brings more population. And along with that comes the affordability. It's just that more affordable market. You've got more cash in the bank because you're making great money. You're spending less on rent, food, and other sort of day-to-day things and activities. And with that just drives occupancy rates because you've got more people coming in willing to pay more money. So it drives rents and occupancy rates at the same time. And yeah, like I said, sits at about 95% multifamily. So risk and reward evaluation. Like we spoke about, high cap rates in Houston. So you've got that lower price of entry compared to Austin, New York, San Francisco. So for cash flow, it's definitely a great place to obtain that. The affordability advantage, which we've spoken about, remains so much more affordable than somewhere like New York or anywhere in LA. And essentially that diverse economic base. So it is heavily energy. I think the GDP is like 2/3 energy. So it is very, very energy, but it does have a lot of healthcare, aerospace, manufacturing alongside that. And look, energy is a great space, especially I'm not political by any means. I've never voted in any country, so I have no horse in this race. But you do hear Donald Trump continuing to say the first thing that he'll do if he becomes president is drill, baby, drill. His exact words, right? And with the top 5 largest energy companies, their headquarters are in Houston. If Donald Trump does get in, it'll be interesting to see how that impacts. You'll be seeing people with the 2 cars, the 2 boats, and the 3 motorbikes again. I can guarantee it. There'll be more money there than a lot of people know what to do with. But I say that, but they find the way to spend the money regardless. But which will be great for the economy. So along with that, the risks though, there's always risks wherever you're looking to invest. And Houston has that. Where it's floods, there's a lot of areas that do flood, and it has flooded and will continue to flood. So it's always something to be careful of and cautious of. And hurricanes. There was only one there, I think 2 months back. It was 2 months, there was one. There was no electricity and for numerous days. And it's just something that sort of, I won't say it's becoming a norm, but it's becoming frequent. So it's just something to sort of expect in that sort of area. And economic sensitivities. So Houston is relying on energy, like we spoke about, but at the moment it's not probably as high as what it usually is, and it's still not in a bad position. So it can only get better, which it's interesting to think about the potential that it can go and how much it can inflate all of Houston and the GDP around Houston and the cash flow around there. Of course, rising interest rates and higher rates. And yeah, I think over the last few years, it's been an interesting ride, but we've just had that first interest rate cut, 50 points. So I think we're all under the same impression, right? That it's not going to be going up. We're all under the impression it's going to be going down. How far down and how fast it goes down, that's where everyone gets to have their own honest guess and opinion. So yeah, at least we're taking it into account, but we know that we're under the impression it's strongly in the downward trend, just over what time we're unsure. So next step for investors, essentially keep exploring Houston. Houston's a great market. Like we spoke about, if you can look at any graph in terms of job growth, rent growth, pricing growth, every sort of growth that you can look at, every chart, it's all in that upward trajectory. So I'm not sure what would scare people away from it. It's honestly just a great market to be in. It's still got years and years of it being in that same direction. It's nothing slowing it down at this point. So look, if you want to jump on a call at all, schedule a consult. If you want to talk about Houston, Texas, just multifamily in general, always open to that. You can visit the website, kingshurstcapital.com, and book through my link. So thanks for joining me today. I'll take some questions now and then I'll let you go for the rest of the night. But yeah, cheers for that.